Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Nina Mishra. My guest today is Jeremy Schwartz, Global Chief Investment Officer at WisdomTree Asset Management. We're talking about investing in Japan today, and Japan was the best performing major market globally in the first quarter. And last year as well, Japanese stocks had posted the best annual performance in a decade. Jeremy, welcome. Great to have you with us.
Nina, this is a pleasure. It's one of my favorite topics, so I'm glad to be here with you.
Excellent. So last month, the Nikkei index reached a new all-time high, and it topped the previous record set in 1989. So after 1989, the stock bubble burst in 1990, and then investors had to wait for 34 years. So we will dive into the factors that contributed to the recent Japanese stock market rally. But I wanted to start with this a new record high and why this is a significant psychological achievement for Japan.
Yeah, I mean, there's a number of things when you see such a big gain in the market, your natural instinct says, "Did I miss it? Has all the gains been had in the past?" And I think on a forward-looking basis, I still think it's one of the better opportunities around. We could talk through the drivers again of what the sort of returns could be over the next decade and how I think about that. But certainly psychologically, it made sense for the Japanese that, they had deflation. They had one of the most expensive markets of all time in 1989, one of the biggest bubbles of all time. It got to 60% of world indexes, basically where the US is right now. But it was a much more expensive market. I mean, we're 20 times earnings here in the US. Their market was considerably more expensive back then. And it deflated, and they had big property deflation, didn't go anywhere for 30 years, but actual deflation, price deflation, they never really got, any inflationary tendencies over the last 30 years. But now it's a different environment, and, sort of profits are up. They're doing a lot of things to try to improve valuation. And so it's really not an expensive market in my view. So I don't think people have fully missed it.
So another important development last month was Bank of Japan's pivot. So BOJ ended an era of negative interest rates. They raised interest rates for the first time since 2007, because now it appears that the country is finally exiting from decades of a deflationary spiral. So could you talk about the implications of this pivot for the Japanese economy and the yen? Because we know the yen recently hit a 34-year low against the dollar, and the yen's weakness is one of the factors that contributed to the rally, particularly rally in Japanese exporters. Yeah. So what does this pivot mean for the economy and the currency?
Yeah, and this also goes back to how do you want to invest in Japan, and should you be unhedged or hedged, and what does that mean? Let me explain one very important part of. I do think the baseline should be much more hedged than it is. When you look at just where the assets are today, it's still like at least 3-to-1 of the assets invested in Japanese ETFs are unhedged. So people are betting on the yen to go higher. Fortunately for them, the yen has gone lower. So most people have gotten this wrong. Now, I think they should still stay hedged, even though a lot of people think the yen is very undervalued and, that the dollar looks expensive. And part of that, I like to allude to what Warren Buffett, who's now one of my favorite Japanese investors is, his biggest investment outside the US is Japan. And he talks through in his latest shareholder letter, with all the resources that he has, and he's buying these 5 stocks he thinks are great value. You can say, hey, he could be buying these stocks in cheap yen. But he's like, I don't think anybody can predict currencies. He doesn't think he can predict. He doesn't think he could hire anybody who can predict currencies. And so what he's doing is he's issuing debt in yen to neutralize his currency risk. And he's borrowing a lot of yen to buy these stocks. And effectively, it's basically, if he were borrowing in the US, he'd have to pay 4 to 5% more, but he's borrowing in yen sub 1% or, very, very low rates. And then he's buying these stocks. Well, US investors too, compared to a local Japanese investor, you're starting out over 5% ahead of the local Japanese investor. And why is that? Well, when you hedge your currency, you get paid the relative interest rates between the US and Japan. And right now, that differential, even though the Bank of Japan hiked rates to 0, there's still a 5.5% spread between the US and Japan. So starting day one, you start out 5.5% ahead. Now, if you're saying, all right, what's this rate differential going to be over the next 5-7 years? Maybe it's not going to be 5.5%. It's going to come down. Maybe they raise rates a little bit more and the Fed lowers rates. We think the neutral rate for the Fed is something like 3.5%. So I think there's a good case that over the next 5 to 7 years, this what they call the carry trade, from hedging currency is like 4%, 3 to 4% over the next longer term. It's 5.5% today. It could be 5.5% for the next 12 months. But you start out ahead, so you don't have to have a view on the currency. You just get paid the carry. Another way of saying that is if you're unhedged, you got to catch up to that carry that you're earning by hedging. And so, yes, the Bank of Japan hiked. To me, you still don't know what's going to happen to the currencies, and I'd rather be hedged than not hedged. You become neutral, and you're starting out 5% ahead today.
Right, I agree with you. Investors shouldn't try to predict the currency moves because currency moves are basically impossible to predict, and they should just follow Buffett, who has just an exposure.
It's funny, Nina. Everybody says that they don't know what it's going to do, but then they default to saying, "Oh, we're just going to keep what we've been doing before, which is to bet on the currency." It's fascinating that dynamic.
Right. So another major factor that contributed to this rally is improvement in the corporate governance. That is usually mentioned as one of the biggest catalysts. And we have seen that the government, as well as the stock exchanges in Japan, they have been encouraging companies to improve corporate governance, use their capital more efficiently. And we have also seen significant improvements, dividends, share buybacks, unwinding of cross holdings in recent years. And I saw an excellent note on your website, WisdomTree. It talks about Japan's MTICCC takes center stage. And MTICCC is management conscious of the cost of capital. Interesting. Could you please talk about that?
Yeah, they've got a lot of companies with price to book ratios below 1. And, the Tokyo Stock Exchange is basically threatening them with all sorts of actions to try to get these companies to improve their valuation. Like a lot of what happened, again, in these deflationary times, it often made sense. They had very conservative cultures. They kept a lot of cash on the balance sheet. There's still a lot of cash on the balance sheet. And that's one of the things that inflates the book value, higher than otherwise would. And so they're, one of the ways you can get your return on equity higher, when you think about what is return on equity, ROE, it's profits over book value. And if you have a lot of cash that keeps your book value higher, if you start doing buybacks, often that'll, it will certainly lower your book value, get the cash off the balance sheet and returning it to shareholders. If it's a cheap stock, that could help increase your forward earnings power, lead to better EPS growth. And so you're seeing a combination of things. One is they're doing more dividends. And I think the average dividend growth on our basket in our currency hedge DXJ was something like 20% last 12 months. And so the companies are growing dividends. They're all doing buybacks. It's sort of interesting when you go back to my carry of you earn 5.5% in interest carry, you also get a 3% plus average dividend yield. So let's say the stock price does nothing over right now with the carry plus the dividend, you're starting out close to 9%. I mean, I don't know, my forward-looking return on the S&P 500 takes a 5% earnings yield, which is a real return. You would add 2 to 3% inflation to be a 7 to 8% nominal return. In Japan, I'm talking about starting out at close to 9% before the stock price does anything. It's a very, very interesting dynamic.
Correct. Now let's talk about foreign investor interest. And you mentioned Warren Buffett's purchase and his investments in Japan's trading houses, 5 largest trading houses. And Buffett said that he likes these stocks for their earning yields and dividends. And we have seen that other global money managers, they now view Japan as a much more attractive investment destination than China. And Chinese individual investors have also been buying a lot of Japanese stocks, I understand, because they have been burnt by their domestic investments in real estate or Chinese stock market. So could you talk about how foreign investor interest contributed to the rally?
Yeah, I do think where there has been a lot of money coming in, when you look at the ETF flows, Japan is one of the top countries and really just the top categories that is seeing inflows this year and really the last 12 months. So investors are starting to pay attention. I'd still say, most of the flows have gone to the unhedged. So a lot of people keep getting the currency wrong. But I'd say Japan is benefiting from two things. You saw one place they're benefiting from, as you sort of allude to, is there's been this aversion to China. You have all the geopolitical tensions around the world. Japan is one of the allies of the U.S. It's our strongest ally in Asia. Them with India combined, seeing both Japan and India as being the top 2 countries being talked about everywhere. India's been one of the top performing emerging markets. Japan's been one of the top performing developed markets. Interesting contrast between the two sort of population profiles, but the sentiment has definitely improved for Japan. And so we're definitely seeing, I'd say modest, it's not overwhelming. I'd say for us, we saw a lot more interest a decade ago. And I'd still say people are probably under positioned because most people tend to be very home country biased and international hasn't worked for them. But partly it's because they were in broad indexes like, a broad emerging market index did less than 2% a year for the last decade. I think it would surprise people that DXJ, our Japan flagship, has outperformed the S&P 500 for the last 10 years. Most people have no idea that it's done that, because they think of international as dramatically underperforming the US for the last 10 years, but not DXJ.
Very interesting. So what about Japanese investors? Are they buying domestic stocks now? Because earlier they were dumping domestic shares. They were burned by the bubble and they were mainly keeping their assets in cash and bank deposits. And earlier cash was not losing purchasing power. But now inflation has started rising. So real value of their cash will start falling. And these Japanese consumers, Japanese employees, they have seen their wages rising finally. So are they investing in Japanese stocks now? And I also read about a new government subsidized savings scheme. Will that encourage investments by domestic investors?
Yeah, they're definitely trying to encourage more. I mean, certainly the pension funds started adding a little bit to that. And then they are trying to make it more of an investment culture, but there is nothing like that point that you made that, hey, in deflation, it was okay to keep your money in cash, particularly when you had a market that was dramatically overvalued. Now, when you start seeing much higher dividends, much higher cash flows, you're getting, if you buy a basket of dividend paying stocks, you get 3% and they're growing that dividend. That becomes a much more attractive position than having zero in cash. And before it had deflation, now you have inflation and your currency is buying less. So, you need to grow it. So I do think some of the dynamics are going to lead to, and then you get past that 40,000 critical level that people remember. So there's that psychological technicals doing better. And there's this sort of fundamental backdrop. But they're also trying to encourage it through tax incentives. They're putting more what they call their NISA program, where you can now do, they sort of upped how much people can earn tax-free, like our 401k or IRA, Roth IRA programs that you have in the US. They're doing more of that in Japan to encourage private investment, but I think they need to encourage their pensions also to do even more in equities and away from the bonds. So it'll be an interesting dynamic, but I do think some of that mindset is shifting locally. There's no question.
Any other factor we might have missed? I guess artificial intelligence frenzy also contributed to the bullish sentiment. And particularly, we saw a rally in chip-related stock. Taiwan Semi invested in Japan. They're expanding their manufacturing in Japan. But the bigger question is whether this rally can continue. And you earlier alluded to the outlook for the next 10 years or so. So tell us whether this rally can continue and why.
I put out a little controversial statement maybe that I think if you took DXJ, again, our primary Japan ETF, and compared it to the S&P 500 for the next decade, there's a very reasonable chance that DXJ outperforms the S&P 500 over the next decade. And, part of that comes back to you're going to earn carry. The question is, how high will that carry be on average for a decade? It's hard to forecast where where interest rates will be between the two countries over the next decade. But I'm going to guesstimate that the U.S. is higher interest rates than Japan for the next decade. And so maybe I'm starting out 3% on average, with that 3% carry. And then the dividend yield is higher. So Japan and DXJ are getting over 3% on the average stock, and in the U.S. you're below 2% on the S&P 500. So I'm getting over 100 basis points of yield. Their dividends are growing even faster than the U.S. dividends. And from a valuation perspective, the S&P 500 is at 21 times earnings. DXJ is at 14 times earnings. So cheaper. So I think there's less valuation. I don't think the S&P 500 is overvalued. I think it's kind of fair value at 20 times. But a lot of people think S&P valuation hasn't come down. I think Japan valuation can come up. So I do think there's a very reasonable likelihood that Japan outperforms. A lot of people worry about their demographics story. They say, how can you be bullish on a country with declining demographics, declining population? And I come back to say, well, it's not about Japan's local economic growth that I'm worried about. They're a global play. They sell to the US, they sell to China, they sell all around the world. And so it's not about their local economy. It's about what is their profit growth and how do they compete. And, their currency certainly is making it easier to compete around the world. But I think they're still a cheap set of stocks. And I think the fundamental backdrop is good with that positive corporate governance. So I think a lot of good things going, for Japan.
So yesterday, the Nikkei posted its biggest weekly drop since June 2022. And for reference, we are recording this on April 19th. And this came amid a major sell-off in stocks everywhere. The Nasdaq is down about 2% as we are recording this interview. But for investors who are looking at Japan now, what are the biggest risks in your view? Is it the possibility of a rise in the yen or rising geopolitical risks that may impact global trade and also result in high energy prices? Could you talk about the risks as well?
Well, certainly you're right to point out the yen. The weak yen has spurred a lot of the profits. And when I talked about, hey, it's been one of the best performing markets in the last 12 months, up 50%, but the earnings P ratio is still 13 to 14 times. It's not like super expensive. That's definitely because earnings have been growing. But so what could counteract that? Well, a much stronger yen would be one of those headwinds. If you got into these, one of the things you do hear about these trade wars, if we get new leadership in the U.S. next year and you get a big trade war where all of a sudden we're tariffing a lot of Japanese goods in some way, or we're trying to weaken, we've got a very strong dollar. If there's policies to try to weaken our currency dramatically versus their currency, that could be short-term headwind. But I still think the longer term dynamics are set up pretty well. But so I think this week's volatility came from, as you said, the Israel-Iran tensions and Israel coming back and attacking Iran, and that caused a sell-off overnight. So that's one of the tricky current dynamics. The bigger issue is those global trade flows over time, and the fundamental earnings backdrop that comes from everything.
Let's talk about your ETF DXJ now. And this is a currency hedged ETF, as you mentioned earlier. And you also mentioned that this has significantly outperformed the S&P 500 index over the past decade, right? I noticed that this ETF has also very significantly outperformed other market cap weighted and unhedged Japan ETFs. So could you talk about the DXJ's approach and strategy, and also what are the reasons of its significant outperformance over other Japan ETFs?
So that over the decade, DXJ versus say something like the S&P 500, it's basically done a little bit less than 1% better for 10 years, which I think most people don't know that there's been a foreign market that's outperformed the S&P 500. Everybody thinks the S&P is beating everything, but over the short term, it definitely has been very strong. I mean, the last 12 months, it's been up over 50% in DXJ. And so there's definitely in the short run, 1 year, 3 years, it's been quite strong, even versus the US, which is beating mostly everything. But the driver versus the unhedged, clearly the currency, as the yen's gone from, well below 120 to 150, if you've been exposed to the currency, that's been a headwind. Recently we're collecting the 5.5% carry that I talked about, where today you're starting out with 5.5% because of the interest rate differential. So you're collecting a carry and the currency is weakening, so there's this extra effect of why it's done even better versus the unhedged because of that. But our process is dividend weighted and has a value orientation, and value has actually done particularly well because of some of these efforts to increase valuations. A lot of these companies are taking action, and you've seen it benefit some of that cyclical growth story. Certainly some of the exposure to the exporters, we tend to tilt towards the global companies and away from just the local companies in our approach. And so that's certainly you're getting some benefit from the weak yen, some benefit from the value tilt, the currency, the carry. It's a multitude of factors that have led to that performance. But I think, Buffett buying Japan has been one of the most positive sentiment inducers. I mean, we wrote a piece 3 years ago saying follow Buffett into Japan. Nobody listened. We wrote another one the next year saying follow Buffett into Japan. Again, no one listened. But in the last 12 months, people are starting to listen. And I would still say it's true. I would still say follow Buffett. He's going to buy some more. There's rumors in just the last week he's about to issue more yen. And the speculation is going to be buying more in Japan. I think we'll have a follow-up headline soon. He's issuing more yen, and when he's done that, he's bought more of those companies. So I would say follow his lead again. It's not too late. Good valuations. And yes, maybe the currency appreciates, but you're collecting the 5.5%. That's how I'd rather do it.
So in full disclosure, I own DXJ and the ETF investor portfolio that I manage for Zacks. You offer 2 more ETFs, Japan-focused ETFs.
Yeah.
These are small cap ETFs. Could you talk a little bit about them? And also, what's the outlook for smaller companies in Japan? These 2 have underperformed DXJ.
Yeah, well, Nina, I'm with you. I've been a longtime shareholder of DXJ, my 401k forever, and even in other. So I've been with you, and I own some of those Japanese companies that Buffett bought as well. I say the small caps are a little bit more sensitive to the local economy. If you're going to ever want to make a play on going unhedged and make the call, I think that is probably where I would go. We do have a small cap hedged and unhedged, and I think the part of it is the big companies are benefiting more from that global growth story in the weak yen. Small caps are more local to the economy. Not as much of them have taken action on that corporate shareholder reform, trying to get their price to books above 1. There was more of the cheap companies. I expect them to eventually follow up. So you might say, hey, the small caps are just as interesting now. Maybe 75% of DXJ has taken some action to address that feedback on the dividends and buybacks, and only 50% of the small caps. So there's more coming. So that might be part of a catch-up trade. And you say small caps are more sensitive to the local economy than large caps. And hey, that's where you have the declining demographics and the more challenges of, importing products and a weekend consumer going less. So there is definitely a more local economy story on small caps versus large caps. But I do think they have some of the valuation potential, and maybe there's some M&A consolidation that comes from this management focus on better costs of capital, better stewards of capital. So there may be something there from, a catch-up trade from small versus large as well.
Excellent stuff, Jeremy. We'll have to leave it there. Thank you so much for joining us today and for sharing your insights.
Well, thank you, Nina.
That was Jeremy Schwartz of WisdomTree. Now let's quickly recap some of the ETF tickers that we discussed. So DXJ is the WisdomTree Japan Hedged Equity ETF. It focuses on Japanese dividend-paying companies with an exporter tilt, as Jeremy mentioned. Now, if you want to look at small cap ETFs, the ticker symbols are DFJ and DXJS. If you want to look at unhedged Japan ETFs, that is, if you believe that the currency will appreciate, the yen will appreciate from here, though I would again remind you that it's very difficult to predict currency movements. But if you want to look at those ETFs, the most popular Japan ETF is by iShares. The ticker symbol is EWJ. And the cheapest Japan ETF, and that's also unhedged, is by Franklin. The ticker symbol is FLJP. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. Also, make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.